I like real estate. It always has been and probably always will be my favorite asset class, but with that being said, I'm conflicted. I want to own businesses, and it's a lot less work than owning real estate. The cash flows of stocks are automatically reinvested, which allows me to compound my money more frequently, as opposed to real estate where, one, it takes time to acquire a property, right? It's not the click of a button. And two, the cash flows that I'm getting from the real estate, I can't necessarily go buy a property for, let's say, $5,000. Whereas a stock, I can reinvest dividends that are worth a few bucks. So the time has come to settle my own internal debate and compare a great stock investment versus a great real estate investment, taking into consideration things like reinvesting of the dividends, tax benefits, and debt leverage. But before we get to that, two quick gems. One, always keep your knuckles away from the cheese grater. And two, please remember to subscribe to this newsletter. We're making you wealthier and wiser with one article a week. And you might be thinking, well, this isn't a newsletter. Well, yeah, I basically am reading my newsletter and putting it into video form. So here you go. We'll be comparing the duplex rental property that I own to a stock returning about 15% every year. But that's compounded daily. And I ultimately think that's a fair number for a great stock investment when you take into consideration that Berkshire Hathaway returned about 17.5% per year, and that's likely the best performance in history for a publicly traded investment fund / holding company. First, some context. I believe my rental property's current return figures are as good as I'm realistically ever going to find. And so here's what it's currently returning on an annual basis after all the costs and expenses, including mortgage payments, and setting aside funds for future vacancies and CapEx. Now, I don't think I'll be able to find this kind of opportunity year after year, so for the sake of the experiment, I've notched the cash flow figures down quite a bit. A quick explanation of each of the line items. The cash on cash return. That's the amount of cash flow I receive into my pockets every year. Number two is the tax equivalent return, which basically includes the benefit I get from depreciation. Number three, property appreciation. I'm assuming a rate of 2% on average per year because the national average is about 4%, but this is a rural cash flowing property, so I don't expect the appreciation to be as big as if you bought in San Francisco or LA or New York. Four, principal pay down. This is the most important return statistic for real estate. Every month, a portion of my tenant's rent goes toward paying down my mortgage payments, right? And a portion of those payments goes toward paying down the principal of the loan, aka repurchasing my equity in the property. Now, unlike interest, it's not a wasted expense. So even as my property may not appreciate over time, my equity position actually grows in the property over those 30 years from them paying down my principal. Now, these figures that I'm using assume that I hold the property for the entire 30-year life of the loan, because at the beginning, the way the loans are amortized, you're actually paying off more of your interest at the beginning, and at the end, you start to pay off more of your principal. We'll explain that a little more later, but first, let's get to the results. So, long story short, real estate crushed stocks. Assuming an initial investment of $100,000, your ending value 10 years later would be $690,451 from real estate and only $448,000 roughly from stocks. What's the main contributing factor? It was the leverage in the real estate. The added return from the tenants paying down my principal loan every year adds nearly 8% return per year. Again, that is averaged assuming you hold the property for the 30 years. Now, 8% return in itself is a decent return, so adding that on top of a cash flowing property, that's just going to be tough to beat. Initially, why this wasn't super apparent to me in the beginning was I thought the daily compounding of the stock investment would have a much bigger effect than it did, and maybe even surpass the additional return that was added from leverage of the real estate. But I guess I was wrong. Here's the full spreadsheet, and please note, I assume that every time my cash account from the real rental property reached $55,000, I was assuming that I'd be able to reinvest that $55,000 amount into a new property at essentially the same return. So that's why you'll see a deduction of $55,000, and that was the reinvestment risk I was talking about earlier. So what does this tell us? Well, first, If you hold on to a property through the life of the loan, that takes a lot of risk out of the real estate investment. Because you're essentially, if you put 25% down, you're essentially getting 8% per year in a return added. You're essentially getting 8% per year as a buffer to your returns. Second, this isn't a perfect comparison. I know there's probably lots of stuff I left out and didn't take into account. You could argue that, my comparisons of the stock and the real estate investment weren't quite apples to apples, but you're never gonna get a perfect comparison. And there's obviously qualitative factors such as not having the time to source and buy a property, or if it just scares you, or if maybe stock scares you more, right? There's a lot of things to take into consideration. But what this mental exercise does is it emphasizes the importance of leverage on a good investment. That's why so many millionaires are created through real estate. It's because they can put up to 75, 80% leverage on every property they buy. And guess what? The best investors do the exact same thing. A lot of hedge funds, when there's a bet they're really sure of, they'll go on upwards of 100-to-1 leverage, right? So that's where the huge returns are often generated. Now, here's what I'm walking away with from my own portfolio. If there's a property in an area I like that's got a cash flow return after mortgage costs of about 5.5% or higher of my initial investment, I will likely purchase the property if there's no better opportunities available, obviously. Because this would result in roughly an 18% annualized return if I just hold the property for 30 years. And obviously, I'm assuming it appreciates by 2% per year on average. But still, that would be a 16% annualized return, even if I got no appreciation. And if I believe my numbers, I should definitely do this in a high rate environment like we're in now, because if it meets that 5.5%, cash flow return and rates fall in the future, I can just refinance and juice my returns even higher. So now maybe I was getting a 16 or 18% return. Maybe I'll be able to get a 20, 23% return. Who knows? Give me your thoughts and subscribe to that newsletter. Alrighty, talk to you later.